Moritz, welcome to the podcast, good sir.
Thank you.
You're a partner at Lightspeed Ventures, as far as I know. Maybe not after this podcast, but at least at the start of this podcast, you are. And it's great having you back on. This is your fourth time.
It might be, yeah.
Yeah, it might be the last time, but for definitely the fourth time.
Yeah, I like the foreshadowing.
The questions are going to be rough. We showed you a list, and we're not going to end any of those. We're going to go right in.
Well, I was shown this list literally 2 minutes ago.
Yeah, that's true. I'll keep you on your toes. Great to have you here. And let's talk a little bit about you. So your background, just for those who haven't listened to the three previous ones, I think we covered in your background a little bit in the first one, but just so for the context for the people, you're from Deutschland, Germany, Hanover?
That's right.
Hanover.
Good memory.
Good, nice city, known for great music. And you have quite a career, kind of like Arnold Schwarzenegger type. But not in the sport. You started off with the professional gaming. And how did you end up in the U.S.?
Yeah, barely professional, I think, if that was a thing at the time. But yeah, I guess I grew up to not too much of a parental expectation. My parents both dropped out of high school, and my brother dropped out of high school, and they asked me to please finish high school. I thought it was well doable while also playing a bunch of Diablo II. That was my game of choice. Fell in love with it in around 2000, 2001. When we also got finally connected to the internet in our little cow town in Germany, near Hanover.
Near Hanover, not Hanover.
Yeah. And yeah, I mean, I really played it for the love of the game, first and foremost, probably, 10 hours a day whenever I could for 7 or 8 years. Peaked at global #1 twice in softcore in 2003 and hardcore in 2004. And made some good money with in-game item sales, which were choppy. Back then, eBay was in its first year in Germany. All of this was, I guess, technically never my IP and also untaxed child labor. And yeah, I only unpacked the whole gaming past many years later when I applied to business schools in the US. I wrote my Stanford essay about Diablo II. So jokes on them now. And did not go straight back into gaming after business school. Now it's actually pretty popular. I think in any given business school class, either at Stanford or Harvard, you have 5 or 10 people. Activision has this very popular rotational program and others too. When I was there, it was not a thing to go into gaming or come from gaming. And so hired very traditionally, did the least gaming thing possibly, arguably, and joined Goldman in the investment banking division with a suit and a tie in New York, hardo M&A and IPO banking for enterprise IT initially. Did that for 2 years. And then in 2016, I looked at the gaming industry, which was about $160 billion at the time. No down year since 1997. We had just helped with the King acquisition. And it just dawned on me that this was probably a space that warranted more proper commercial attention, and it was somewhat neglected by the banks, the consulting companies. No other bank had a gaming practice. I think McKinsey was just starting a gaming practice at the time, and it was one of those moments where you could just beautifully argue from first principles and make a case for something, and so I did, and started the gaming practice in 2016. Worked on it for 4 years. I think it's become a major component of the Goldman banking franchise. And, Himal took over in 2020 when I left, and he's been crushing it. And I went into gaming VC from gaming banking. Not much more noble, but a lot of fun. Joined Bitcraft early, had 3 fantastic years there, and very proud of what we built. Scaled it together to almost $1 billion in assets under management, and ultimately joined Lightspeed pretty precisely 2 years ago. Lead gaming and interactive media there now.
Tell me a little bit more about Lightspeed, because Lightspeed is a big fund, like one of the top, what we would say top 10 largest funds in the world.
Yeah. We'll come back in March when it's probably more like top 5.
The word is on the street that this current round went pretty well.
Well, still in progress, but so far so good. We're about 30 billion in assets under management right now. It's a firm that has its history in enterprise. So it started as a pure early stage enterprise VC firm, and over the past 2 decades expanded into consumer, fintech, healthcare. And it's also one of the few firms, and I think the only tier 1 scaled VC firm that takes a genuine global approach. So we have offices in the US, but we also have offices in Europe, in London, Paris, Berlin, have been in Tel Aviv for a while, India, Southeast Asia, China. That's actually rare. Most tier 1 VC firms, I would say, are US plus, or have one or two partners in Europe. So we think we're at a point in time where talent is genuinely globally distributed. We have the tools and the technology to enable people around the world, and I think extraordinary ideas can come from anywhere.
Yeah,
and it's no longer dependent on physical proximity, whether that's the traditional San Francisco Bay Area ecosystem or other hubs.
What's the difference between working at a prominent gaming VC fund like Bitcraft, which is not small for gaming VC,
Not at all.
It's a top player, to going into a generalist fund where you're running the gaming side, but it's a gigantic fund?
Yeah. I liked the idea of joining Lightspeed. I had my thesis at point in time, but I was worried that maybe it wouldn't work out in reality, which was, I think the most interesting things in gaming, they fall into intersections. I mean, now, obviously the intersection of AI and gaming is a big part of the hype. But even if you look into topics like, AR or AI-enabled hardware devices, these are topics that permeate enterprise domains, from machine learning to computer vision to, in some cases, custom chip design. And I actually really enjoy bringing in those partners from enterprise, from consumer, depending on what we're looking at. If it's a game studio, we have Paul Murphy, who leads Europe for Lightspeed, who actually founded 2 studios, and that's my partner here in Europe for anything gaming.
He has that New York startup, Two Dots.
Yeah,
Well,
Dots, which
yeah.
sold to Take-Two, and he also founded Giphy.
Nice.
Yeah, so he's great for anything game studios, and then game platforms I look at with my partners from the consumer team, depending on whether it looks more like social media or maybe an e-commerce application or gamified consumer. And when we go into tech, whether that's engines or AI topics, these are things I look at with my partners on the enterprise team. And I think we're always, when an opportunity, this is not just gaming related, but when an opportunity comes into Lightspeed, there's usually a partner who's best fit in terms of topical expertise to look at it. We call that internally the number one on a deal. It's the check writer who puts their name against the investment. And then we compose deal teams dynamically, and to some extent we even compose ICs dynamically. So
what's an IC?
Sector IC, that's the investment committee. So effectively, every investment requires a vote. It doesn't have to be consensus. For us, it's typically 4 out of 6 at least have to support a deal, including the person underwriting it, of course. And it's working really well. I think it's hard to promote this cross-sector collaboration when you have actually delineated funds. So we don't have a gaming fund. We don't have an enterprise fund. We all investors at Lightspeed collectively across geos, across sectors, invest from one fund. The fund is technically delineated by stage, but also my incentives and my compensation are cross-stage. So even though I focus personally on the early stage, my personal dollars and success from Lightspeed is derived across all the activity that we do as a firm equally.
Web stores. You've seen what good looks like, but have you seen great? AppCharge is the direct-to-consumer platform backed by the likes of Supercell and built by monetization pros from Moonactive, Playtika, Huge Games, and others. People who know the difference. AppCharge powers over $500 million in transaction a year for top studios, optimizing every detail. Deeply personalized web store offers custom-made design, industry-leading monetization features, in-game payments, SDK, and more.
70% of top grossing games already have a web store, but the ones scaling fastest, they're doing it with AppCharge. Learn more at appcharge.com.
And so what's the difference between that type of approach and let's say A16Z that famously has divided into like American infrastructure or something like that, and then it was like gaming even has its own brand, A16Z Games. That's a comparable in terms of a size fund.
Yeah. I think the argument for what A16Z is doing is by separating it into individual vehicles, there is naturally more internal competition. And that's not necessarily a bad thing, right? You want everyone to hustle. Every domain needs to carry its own weight in the way that they also need to fundraise separately. To some extent, by and large, the A16Z Games fundraise is separate from the main fund. And that can be a good thing. Ultimately, you want people to be incentivized to really crush it in their respective domains, to give it their all. And I think also to maybe make organizational decisions on whether certain domains are also topics for the next fund vintage or not. For us, this works well, and I think it's actually pretty difficult to set up this cross-sector, cross-geo collaboration because you have to ultimately make sure that everyone's intellectually honest enough to elevate the things that they really believe cross the global bar. There's no deployment pressure naturally on anyone, so we don't have to deploy in games. If we think that in 2025 we didn't find anything that crosses the global bar, then we won't invest in games. Probably not be great for me. I'd have to reinvent myself if that were the case. But it's a hypothetical scenario that works on a fund level for us. It wouldn't work if it's a separate fund that has deployment guidelines and needs to make sure that within 3 years a certain amount of capital gets deployed in the market. But I like to think a flexible model is a better model ultimately for LP returns, because you're otherwise creating just a constraint optimization problem. You're solving for multiple local optima versus solving for one global optimum.
Let me dumb this down. So correct me if I'm wrong. If you have a fund, like a big fund, let's say you have, $10 billion fund, and that is divided into smaller sections, gaming, fintech, biotech, clean tech, whatever it is. In those type of situations, these sub-funds are able to make decisions rather quickly, and they're all experts in that field, but they're also tied to deploying exactly to that field. And so the cons is that you have to deploy even if it's not growing at the moment or when the thesis was done, compared to in a larger fund where you are at, you're making the best possible investments overall for the venture. But the challenge is that you go to IC, so investment committee, and you give your vote on a fintech investment. And so you're not an expert in that. You got to become an expert overnight. So it's a lot of reading, a lot of learning, but I'm sure you provide excellent material for that. And you have to weigh in on something you're not an expert on. But, I don't know if that's a pro or con.
It used to be like that for us, where we had one IC for everything. That has changed too. So we try and move decision-making velocity as close to the centers of expertise as possible. So we have a gaming IC, a consumer IC, an enterprise IC, and that is where those decisions are made. So part of the organization makes investment decisions that then affect the entire fund. And you're totally right. I mean, I see our life sciences and biotech memos, and I frankly shouldn't be voting on this, and I don't.
What are the sort of non-negotiables when getting an investment from Lightspeed?
Everyone at Lightspeed has a bit of a different investment style, so ultimately it comes down to partners' preferences, and I'm sure the answers also differ by sector somewhat naturally, but if I'd have to tease out one common thread, I mean, two things I don't like to negotiate on are truly extraordinary founders, and that's a loaded term, right? And you can discuss all day long what that means, and we do. And we recalibrate internally all the time too. And sometimes you think you understand the spectrum of possibility, and you meet just outlier people that have you rearrange your scales a little bit, which is something I genuinely love about the job. I like this phrase of unique insight that, if true, is profound. And I think that's a powerful way to describe an extraordinary founder, because when you spend all your time in gaming or in your area of expertise, the truth is that in a given call or pitch, you're not genuinely learning something new. Like, it fits within the frameworks that are repeated over and over in the industry. But sometimes there are pitches where your perspectives genuinely get challenged, or you learn something new that is so intriguing and so interesting, and has you spend more time with something you otherwise would have never thought about. And those instances I like particularly. I would say that happens maybe less than once a month. And that's a strong signal to lean into and spend time with that founder, understand where they're coming from, why they have these perspectives. And I love to unpack contrarian theses. I think, one thing that gets talked about sometimes also is TAM. I think it doesn't matter
Target
as much.
addressable market.
Yeah. So size of the market for the best things doesn't matter, because some people will create markets, and the types of founders that share this unique but if true profound area of expertise, that those are typically the founders that go after things that don't neatly fit into spreadsheets. So that's something I like.
How is this spotting going on? Like, how do you know that somebody's truly exceptional? Do you spend time with them on site physically, or does it come through your video calls, or like how does that happen?
Initial meeting for me typically is over Zoom. Probably 80 or 90% of initial meetings are. I think, without exception, at Lightspeed, any company I've ended up investing in, there was extensive time spent in person. Just spent, over the last 2 weeks, there's one investment that we ultimately didn't pull the trigger on, but I think within like 4 or 5 days, it was over 10 hours spent with the founder, including over a weekend. And it was one of those intriguing cases that...
Why did they reject you?
The other way around. No, look, it's very compelling, but I think there were, on our end, a few too many question marks. Yeah. But it was a great process, and incredible founder, truly incredible founder.
What does this entail, like spending a lot of time? Does it mean like you go to their offices, or you said on the weekends? Do you meet some, like what? I'm just curious about the process of understanding that this is truly exceptional team or a founder.
Yeah, you never know. Our job is not to predict the future. Our job is to see the present clearly. And so there are precursors of greatness, but look, the reality in venture is most things don't work out in early stage investing, right? So that's baked into the investment strategy, and that's fine. That's also why, by the way, I find this narrative of, oh, look at all these game studios, and most of them don't work out, so it's not a venture investable category. Well, that's true for everything in early stage venture capital. You can say the same about SaaS software, which is the bread and butter of the U.S. American venture capital industry. And so, yeah, most things don't work out. That's priced in, right? Because when they work out, they get pretty expensive. And if we look at historically how our funds have been returned, we're on vintage 15 now. Yeah. There's typically, I would say a handful, two handful of companies among a few hundred in each fund that really mattered for the fund. And we internally, we also ruthlessly focus on those impact companies and make sure that we enable and elevate them as much as possible. Because, to some extent, this is not a business that you win by mitigating your downside. This is a business that you win by maximizing the few outliers that are naturally created over the 5, 6, 7 years of a fund's investing period.
Most don't work out. Can you talk to me about what works out? And how does that look on a financial perspective? What are the percentages that you're aiming to own, and what is the type of an exit? And then let's unravel through that to other type of funds and how they do their investments. But on Lightspeed's perspective, what is a investment that works out?
I mean, in terms of ownership percentages in the early stage, we typically try and get to about 15%. I'd say 10 to 20% is a good range. Because obviously there will be future funding events, there's dilution. I mean, if we like our portfolio companies, we obviously keep layering in capital. I think there are now a few companies where across Lightspeed funds, we have a couple $100 million of our capital deployed against into individual companies. It's a value proposition for us as well to be able to kind of layer in capital all the way through, possibly an IPO or a scaled exit. For us, we're currently investing from a $7 billion family of funds. Our LPs, I would say, expect at least a 3x on that, 4x better. That's what we've historically delivered for now almost 30 years with quite some consistency, which helps with fundraising in an environment like the current one, where I think it's more challenging, certainly, than by and large we've experienced it in the 2020-22 period, not just for startups, but also for fund managers. And so to return, I mean, this is high-level math, but to return a 7 billion fund 4x, that's 28. Let's call it 25 for sake of math. If you own 5 to 10% at point of exit, that means you need to deploy the $7 billion into things that ultimately will create a consolidated $250 to $500 billion in exit value. So when you have to invest in companies that together are worth, 250 to 500 billion, the question is, how much does it matter to be in a company that ultimately becomes a $1 billion company? You literally don't feel that in the fund. Even 5, you barely feel. So 10, you start feeling. Investing in a $50 billion company at 10% gives $5 billion back into the fund. That's not even one turn on the fund. So it's basically this ruthless focus on things that can have massive, massive scale. And look, hitting a $50 billion company is extraordinary, and a turn on this fund is extraordinary. And obviously, ultimately, those turns will be made up probably out of 20 plus key companies that in aggregate get you hopefully to at least 3x of like a 4x, 5x fund. But that's the fund math. And so you could have one of these work out tremendously, and most of them work out not at all, and still drive a pretty meaningful result for LPs.
$50 billion exit is insane, because like a decacorn would be already a win for almost anybody. But for you, it's like, oh, cool, that was nice. That was like an appetizer. And
no, we're very happy with $10 billion companies, just to be clear.
Just decacorn.
But it also then, I think it frees you up a little bit also, because when you invest or make investment decisions in early stage, you kind of want to ask yourself, do you see the light at the end of the tunnel for this to become a $5 billion plus company within, call it 7 years?
Mm-hmm.
And while you can never predict that, of course, right? Like there's a lot of things that look like they can and they don't for various reasons. That's super difficult. Execution's difficult. You don't know what competition is going to do in the next 5 years. Market changes, all kind of issues, talent problems. But surprisingly, you will actually often look at something and there is no light at the end of the tunnel. There genuinely is, for a lot of things, no way. Like you cannot articulate a way to get to $5 billion. So that's out. And I think actually there are a lot of projects in gaming that fall into this category.
Mm-hmm.
Like to get to 5 billion, for example, in gaming tech, there's only 2 examples. I mean, there's some privately traded companies like Perforce, for example. There's really only the 2 engines. I mean, if you broke
AppLovin?
Yeah, AppLovin is a good example, actually. It's
was
kind of
that?
like sometimes the question, like, what's a platform?
AdTech is definitely there. Iron Source, I'm not sure what the price was, but
Yeah. So, but it's probably fair to say there's a handful or maybe 2 handful of companies that crossed that bar ever
yeah.
in game tech. And so kind of begs the question, how good is it actually of a business to serve game developers? It's a relatively small market versus other SaaS categories.
Yeah, versus content and whatnot.
Or anything that markets to all developers.
Gaming tech is something, of course, naturally I've been looking for. It's not something for the biggest funds, but there are interesting, like there's intersection of gaming tech and broader tech. Like let's say Discord, as an example, is something that I don't know what their valuation is, but it has to be in billions. So when they kind of move outside gaming, just like AppLovin, I feel like the valuations keep going up. And that kind of leads to my question. The current valuations in gaming are not great. Like we saw Plarium being sold basically at 1x revenue multiplier. Another Easy Brain company was sold again a little bit over $1 billion. That was, I think it was 2x revenue. Like how do these current valuations play into Lightspeed's investment thesis?
Yeah, I mean, you can look at it or you can ignore it because investing now will be an exit in 7 years and market cycles are probably going to look very different. But I mean, obviously the intellectually honest answer is you should look at it and you should take it into consideration. And you probably want to peel back a layer and not just say, oh, so studio investing doesn't work or edtech is broken and doesn't work. Then the question is why, right? Like what kind of studios by and large might not work? What are the patterns of those? Is it a specific platform? Is it a live ops issue? Is it a mismatch between development budgets and what comes out on the other end? So we're trying to have those discussions internally. And I think it's good that different funds have different strategies, especially as it comes to studio investing.
Yeah.
I think platform and tech investing in gaming looks a little bit more like traditional venture capital. That's something that team at Lightspeed could probably also do without having a dedicated gaming professional. That's just consumer software or enterprise tech, with the exception that it serves, initially at least the gaming audience or the gaming industry. But yeah, as you said, a lot of these breakout cases, they either move from serving game developers to going broader and serving developers globally, software developers, or from a gaming audience to a broader consumer audience, like in the case of Discord, or they move from being something for developers to being something for everyone and enter domains like UGC or enable creation to non-professionals. I mean, this whole class of AI-enabled UGC, prompt to game, we're kind of at the cusp of actually enabling quote unquote everyone to make a game. And there's so many different approaches to do it. And it's early, right? So I think it's very easy to fall in love with the thesis absent of real product market fit, just because it's an interesting topic, or you can envision a future where this would be the case. This is another fallacy of investing, I think. It's very easy to see certain futures and be quite certain about them ever existing, and it's really hard to time them.
Yeah.
And for us, we don't just need to be right on a certain type of future. We certainly need to be right on the timing for it. And a great example is AR. Do I believe that ultimately we'll all wear smart glasses? 100%. Like, I'd be shocked if that were not the case. However, I don't think it's going to be the case in the next 5 years. So it's probably not a sensible investment strategy for this fund. And so this is something I spend a lot of time on, trying to figure out. I mean, there's so much interesting stuff on the AI front that fits into that, and we talked a little bit about it yesterday. Generative games, whether that's using existing infrastructure, engines, code base, assets, but in a semi-automated or automated way to basically create games. That's kind of like that's one type to do it. Then there are these generative video models, and that's gotten a lot of attention initially in research about half a year ago, and then over the past few weeks we actually we saw a few pop up online, and you can play around with the Oasis model, for example, play what people dubbed Dementia Minecraft. It's not an experience that's very engaging or retaining. I don't think many people came back on day 2, but it's besides the point, right? It shows that this is somewhat possible, that training cost and inference cost are reasonable enough to put that out there and in the hands of millions. And obviously, it's only going to get better from here, right? If you go back and look how dogs looked in Midjourney 3 years ago, they all had 7 legs and 5 eyes, and everyone was making fun of it. And now it looks pretty good.
Yeah.
And so we might see the same play out for generative video models. There's generative scene models where instead of being trained on 2D video data, which people call 3D, it's very confusing because you always add the time dimension to it too. So moving from 3D, i.e. 2D, to 4D models, i.e. 3D, and train on actual 3-dimensional data could be interesting. I personally don't think we'll see AAA titles done this way anytime soon, or possibly ever.
Attention app and game developers, are you ready to unlock the secrets behind the world's top performing apps and games? With Sensor Tower, you get the ultimate competitive edge, whether it's breaking into new markets, fine-tuning your UA strategies, or boosting monetization. Dive into data like never before, track global trends across app stores, analyze market-leading in-app purchase and in-app ad strategies, and benchmark your performance with real-time insight. The best part, Sensor Tower doesn't just deliver data, it helps you turn it into action. With intuitive tools and expert analysis, it's everything you need to make smarter, faster decisions. Thousands of app and game studios, from indie creators to global giants, trust Sensor Tower to help them win. So why not you? Start your free trial today at sensortower.com. That is sensortower.com.
There are some hard issues, I think, in the way that image and video are, well, this is a simplification. Image and video models are pixel-based and games are state-based. And so that doesn't help. If you think of a complex game like Diablo, for example, where you have characters, character classes, skill points, skill trees that all interact with each other. You have items, various item slots. The items have all kind of pre-rolled, randomized prefixes, suffixes. Your damage is a function of attack speed, enemies' resistance, etc., etc. Even all the video information in the world probably makes it borderline impossible with a transformer-based model to infer all the underlying algorithms and code base. And so I don't think the games will, these generative games or generative experiences, they're probably gonna look a little bit different from games today, and that's fine. And maybe that's actually taking a lot of attention and mindshare. Nevertheless, just like mobile games look quite different from PC and console, and are now the biggest platform within the global gaming industry.
Strauss Zelnick is the CEO of Take-Two Interactive. Regarding AI, he said, I'm quoting, "I would love to say that it's going to make things cheaper, quicker, better, or easier to make hits. I don't think that's the case. So he kind of basically shut it down to some extent, that the help from AI is not going to be so dramatic as the most bullish scenarios are talking about to existing games that they are developing themselves.
Yeah, there's two ways to use AI in games, and we primarily see the former, and I think it's the less interesting of the two, which is, I think that's mostly what Strauss is talking about. Use it in pre-production, production to, as he said, be a little bit underway faster, cheaper. I don't know about better necessarily. And it feels like most of the stuff is helping you get to human-grade quality, but with shortcuts. But either way, this is where probably 80% of the AI companies in gaming are focused today, is accelerating devs or maybe replacing devs. I think the more interesting applications are in that second category, which is use it to drive novel gameplay. Previously, I like this term, previously impossible experiences.
Exponentially more immersive.
Yeah, if that's, I mean, AI NPCs are like the classic example. I think, I don't think you want to play your game, then there's one random NPC that you can go to and ask like a chat GPT, and you're like, cool, I'm done with this now. For after an hour, I'll go back to the actual gameplay. So it obviously needs to be integrated. I think agentic simulations at scale could be really interesting. Like, what if you can really bring entire cities and towns to life?
Sounds boring.
Yeah, I mean,
You could just walk outside.
That's the real world. Yeah. Yeah. Great graphics, shitty story.
Yeah. From stress to Cress. So let's talk about, like, Cress has been, so on our podcast, Cress has been quite, not unusual himself, so quite critical of big VCs, especially in gaming. And if I'm misrepresenting him, I don't know, but I'll try to kind of summarize his point. He talks about big size VCs, so probably multiple $100 million to $1 billion and more, investing purely into game. In his view, creates impossible to return scenarios. So if we think about games or game companies that would exit, they would need to be $5 billion or more for exit, and there hasn't been many of those exits in gaming. I think Supercell was 5, and then the second time they sold was 10, and that's like one of the most valuable companies. King was, I don't remember what it was, between 4 and 6, I think, when Activision acquired it. So these are like the top companies, and the exits haven't been, they have been considerable, but not of the same magnitude. He talks about that one of the driver for a big size gaming VC fund or any VC fund is the more capital you pull, the bigger management fee you get, because typical structure, correct me if I'm wrong, is 2 and 20. So basically saying that you take 2% of the entire fund size as your management fee. And the fee is what that pays for everything, for the salaries, for the lawyers, for the research, you name it, in order to run your fund efficiently. And then 20 means you take 20% of DPI. So meaning that if you have a $1 billion fund, you return $2 billion, you can take 20% out of the second billion after you've given 80% of what you made back to LPs, so limited partners, meaning the investors. And his point is that if the fund is very large, then the 2% is actually a lot of money. And that, he says, does not create the same type of impetus for the investors to seek for returns, because they're kind of, in terms of a general partner, they're kind of doing good. They might be getting millions in salary just for managing this fund. And of course, like junior associates are probably not that well paid. And then the final one, because these sides are getting bigger in size, they're starting to compete in the type of auxiliary services they're offering and almost becoming like mini publishers. Having all kinds of different, like not all, but there are large funds that have multiple different type of experts that they can, hustle around between the investee companies, making them more attractive. But at the same time, he's arguing that that's not the job of an investor. Investor is helping with the capital for the company to grow. There's some advice and so forth, but they're not publishing games for their companies. They're assisting in a totally different level. So the 3 challenges, so impossible returns, big management fees, and playing a publisher. What do you think about this?
Yeah, I think there's actually a great answer for all of these.
That's why we have you here.
As per usual, with Mr. Kress. So impossible to return. You said you kind of need these $5 billion exits, and there's very few. I mean, okay, this representing.
I can be Kress. I'll start yelling at you.
So I think the most expensive game studio rounds, those rounds that big funds like Andreessen, like us, actually participated, I think kind of caps out at about $100 million valuation. So just to name it, if you get to a $5 billion exit, it's like a 50x on that investment.
Yeah, that's crazy good.
So that's pretty good, right? You can have 10 that go to shambles, and then on average that's a 5x. Great fund. Yeah. So take one that goes to 5 billion, take 9 that go absolutely to shambles. You can't even recoup your capital. Great fund overall. So I'm not sure if that holds, right? We don't need a 5 billion exit for things to work. Actually, in this case, for the most expensive thing, a $300-400 million exit would work nicely with the return math for the fund. So I think it's probably a little bit overdrawn. The second one on management fees, I think it's a common criticism of large funds. I would say that dynamic definitely exists. All right, I think there is a clear incentive for fund managers to raise large funds because you can almost, I think there are instances where the business has become managing management fees and not managing good investments. The truth is also, so let's see where the management fees really accrue. At a firm like Lightspeed, it probably affects maybe 5% of the people who work there. And those aren't even the ones driving most of the investments at that point in time. They're really concerned with organizational leadership. So people like me who drive sector areas, the partners across enterprise, consumer, healthcare, fintech, they don't see any of the excess management fees is the truth. And so for them, the dynamic and the incentives actually remain unchanged. I think it'd be not intellectually honest to just dismiss this topic, and that dynamic certainly exists. For this next fund that we're raising, and can't talk too much about it, but we could certainly make it a lot larger than what we'll ultimately end up announcing. We have to be careful not to make funds so large that we can't deliver on what has historically been expected in terms of TVPI and DPI. Because it's great to take all the money you can get, raise a 40%, 50% above target fund, have a blast, compromise over a 3-year investment period because now you have to logically lower the bar because you need to get more dollars out with the same people over the same time frame. So, I mean, almost by pure deduction, average quality of investment would go down. Almost by extension, returns should come down. So it's a dangerous game. Yeah. And we want to scale in a way where we feel that with the team we have, with the bar we have, we always have a strong case that we can service those dollars. And so, yeah, I mean, on our side, there's consciousness around this too. It'd be easy to get a quick short-term win on management fees. But if you compromise real returns, you might not have a firm 5, 6, 7 years later. Yeah. And it's probably not the smart long-term strategy. And then the third one was?
The third one is playing a publisher, so having too many services. It's also something that Mitch Lasky has been doing these jabs at some larger VCs that have added a lot of auxiliary services and kind of making the point that that's not what venture capital is about. Like, you shouldn't add all this extra just because you've grown in size. Just rather limit the size of the capital you take, as you're saying you're limiting, and focus on what you do rather than adding all this extra.
I think it's a very simple answer. Venture capital is in the business of returning money to LPs. So and I don't think there's one right approach to do it. The world changes. How founders view VCs changes. Benchmark has one model. A16Z has a different model. I think they're probably on two opposite sides of the spectrum. And by the way, obviously, it's in any VC's interest to position themselves well against anyone else. So to some extent, it's also a dynamic playing out here. But look, the job is to build the funds that have the best return math for LPs. If you think the most important thing in a given market, and this changes whether it's, quote unquote, a VC market or a founder market where, VCs have to say or founders have the choice, respectively. If you think you have such a convincing pitch with these auxiliary service that you provide, and we make some conscious choices there too. Like we run gaming and interactive media at Lightspeed pretty lean, as you know. So you can also be a big firm with a small setup. We have integrated functions across talent, PR, marketing, but we don't intend to, and I don't think we'll ever provide publishing support in-house. And we also partner with third parties on a lot of these topics. But ultimately, you got to deliver nice returns. And I think for some firms, quite successfully, I would say, by and large, for Andreessen, it's been working out really well. The whole thesis to build a content organization, to build this support infrastructure, this was something that Andreessen came up with many years ago. And that's actually why they're a household name today. And so I think it's short-sighted to say this is the right way to do venture capital. It's almost like saying this is the right way to do a business or start a company or scale. There's always different flavors to it. It lends itself also to the style of founders of VC firms. And I think there's beauty in them being different, just like we like our portfolio companies to be different. And ultimately, founders have the choice.
Exactly. You said like $300, $400 million exits are perfectly fine, which have been several, but not too many. And when we think about the game industry as a whole, it has consolidated rather quickly, especially during the 2020, 2022, kind of the whole mobile just suddenly like clinched together. And then, the Microsofts and all of that kind of happened at the same time. Where are we headed in that? Like, does that have an impact to the M&A activity? So M&A acquiring companies. And again, if they're just trying to explain this to dumb people like myself, if there are less acquirers, to the fieldmans like myself, there are less acquirers, that means that they are looking for bigger deals or a bigger size of the companies. And so if the mid-size acquirers are being taken out of the market, let's say Take-Two acquires Zynga, and now Zynga is not conducting the same type of M&A activity, and the targets that Take-Two are looking are probably much larger than what Zynga would be looking at before, just hypothetically and just using examples. And when you take these sort of a mid-level acquirers off the market, then that creates a bit of a vacuum in the exits, because now there won't be probably that many under $100 million exits, and everything that they're looking for is probably companies that are making 100 or more millions a year, and then that limits the amount of companies that are possible, and then so forth and so forth. That kind of reduces the M&A activity. How does this hypothesis sound?
And the consolidation I'm more worried about is actually just consolidation of how many titles make up the large chunk of the annual gaming revenues. So I think it's gotten harder and harder for games to push into real scale of commercial success. And, to some extent, it's just efficiencies that large players are drawing from their IP around UA, obviously, and other factors. And I think that's actually something that keeps me up at night. On the M&A front, maybe I don't spend too much time thinking / worrying about it. You also, to counter that, you have the positive dynamic that now you have other media companies. I guess Netflix is a great example. New York Times, technically it's a publicly listed gaming company.
Yes.
So there's all these divisions from non-endemic or non-traditional acquirers that are also filling in the void that you're describing. So, and again, I think it's always a little bit difficult or dangerous to pay too much attention to these moments in time or like points in time, because making an investment decision today will drive an exit in 7 or 10 years. And so really the question is, what's the M&A landscape going to look like in 2034?
Mm-hmm.
I don't know, man. You know what I know is working with extraordinary people on groundbreaking ideas that challenge the status quo is probably a good way to invest.
Mm-hmm.
And that's honestly the most important thing you need to get right. And then a lot of the other things around you, especially the things you can't control, I wouldn't worry too much about it.
Yeah. Okay. That's a good answer. You mentioned the consolidation in terms of consolidation of revenue. That's true. The other part is just how that scale and that top position affects their economics of those companies, is that they become so much more efficient than those that are challenging them. I remember I was looking at Roblox's, like how much these guys spend on marketing. They essentially control the UGC to a large part, probably make most of it, like Minecraft the second. And they spend less than $40 million a year on marketing, which is absurd, because if you want to challenge the incumbent, then that incumbent not only is a decade ahead of you, but also is not even spending on marketing. It's yeah, I don't know. It's just a comment.
So the way to kill incumbents is to
Reinvent.
Exactly, and not beat them on their home turf.
Yes.
So the question is, who's going to become the Roblox of AI, right? When right now, I mean, yeah, kids and teens are playing those games, but kids and teens aren't really building those games. Everyone, I mean, not the listeners of this podcast, but I think the public perception is Roblox is a platform for kids to play games and for kids to build games. By and large, kids aren't building those games.
No.
It's professional developers, right? So how does a platform look, and what does it need for kids to build these games, right? And probably AI is an answer here, or part of the answer. So, I mean, Roblox is heavily investing into AI. Roblox might as well end up becoming the Roblox of AI themselves. But by and large, history repeats itself on this, and it usually doesn't work out that way. And when you have transformational shifts like the introduction of the internet, the introduction of the mobile phone, the introduction of cloud, and now again, I think the introduction of generative AI or other AI technologies, you usually have a value transfer from incumbents to challengers. Now, AI is a little bit different, some people argue, just because how important scale is in terms of capital availability for compute, for data, for talent. And so there is certainly that dynamic, but I'm just a hopeless optimist and a firm believer in the fact that there's always going to be these things that start small, that generate momentum, that attract the best people. The best people want to work on interesting stuff. The genuinely best people in the world, by and large, they don't want to work for big companies. And the best people always win.
All right. I agree to some extent. You have to have a little bit of luck as well.
It helps.
This podcast is brought to you by AppsFlyer. In today's digital world, understanding your app's journey from discovery to download is more than just insightful. It's essential. Enter AppsFlyer, the leader in mobile attribution and marketing analytics that allows you to measure the full potential of your marketing efforts, making every ad dollar work smarter. With AppsFlyer, that's your new reality. Dive deep into data-driven insights that reveal exactly where your users come from and how they interact with your app. AppsFlyer, where your app's potential meets performance.
We mentioned A16Z multiple times. So Andreessen and A16Z is the same thing, just for the listeners. And that is a prominent venture capital firm in the US. They have some interesting models that they use for the size of a fund that they have. So A16Z Games is a prominent game investor. They have two funds. I think first one is about 600 or 800. The second one is at 600 or 800, either or, well over $1 billion that they're investing. And they're become much more prominent name through Speedrun, a concept where multiple time of years they sort of create this incubator in a way. So teams from around the world apply. They bring them in either SF or LA. They work for 8 weeks. They make a prototype, and then they're showing this through these really, really cool events that A16Z throws, where a lot of investors from all the funds come in and watch these pitches, and then are following the investments together with A16Z. That model has been in many ways praised by the founders, but it has also been criticized by other funds and, of course, Eric Kress. What's your take on this model? Not per se that, running an incubator is a legit model, but how does that type of a model sits with a larger fund? We're talking about a fund that has to return over 600 million, and they're essentially doing pre-seed investments, so investing early into a team. Pros and cons, like can you talk through it as a experienced investor of a large fund?
Yeah, I mean, it's almost directly opposed to the model we're running, which is about 2 investments per partner per year. So that's my answer.
If I would be against it, I'd say, okay, this is pretty difficult because we're going to do a lot of investments, and that means we will have a lot of founders that we have to cater towards, and that will strain us really thin. Because you write a couple of big checks a year, you get about 2 to 3 companies you invest annually, maybe sometimes even 1, sometimes even 0. And so that allows you to focus, but your investment size it's not as distributed. But now I'm at A16Z. I'm looking at Moritz interesting strategy, conservative. I understand that. Good for you. I'm going to do something different. I'm going to get into as many deals as possible early on. I'm going to look at the market. I'm going to have them come to me in the earliest phases, where my initial check, which I believe is 750, is going to get a nice portion of that company. I'm able to follow through. And through that, my deal flow is huge. I get a big portfolio of a lot of small companies. I don't care if 90% of them go to 0, but at least I'm able to follow through as a lead investor in their subsequent rounds. And I'm also able to pull in the larger VC community through my events that are really cool in the coolest locations. And everybody wants to come in, and everybody does come in, and we can invest together into a lot of these exciting startups that we present in really good way at our biannual Speedrun events. Moritz, what do you think about my concept?
Do we really have to talk about Speedrun this much?
Yes, I mean, because like there's there's Eric Kress has been critical of it, but Eric Kress is not an experienced investor.
He's not really known to criticize things.
No,
it's surprising.
He's usually optimistic about everything and supportive
and complimentary.
And but this particular thing he has been criticizing, and I would like you to strongman it.
Look, I mean, I think good things, or at least good things singular so far, has come out of Speedrun, which is KID.
Which you invested into?
Which we co-led the Series A together with Andreessen.
Mm-hmm.
So it's certainly a model that can work. I mean, the one thing I will say is you can take it apart from an investment, ownership, returns perspective. The other thing that's really not trivial is the amount of people it takes to run it. I would probably think that 2/3 of the team is involved with Speedrun to a large extent. And so that's a big organizational choice, right? I don't think there's actually any other fund who could even run this if they wanted.
What do you think about this the challenge of this is also that not only are you getting a lot more founders that are expecting your support. Let's say I'm going successfully through a speedrun, enjoying tremendously, amazing 8 weeks. I gel with my co-founder. We show a demo, standing ovation, and we get the check. And now, as we're going through towards our seed rounds, following one, I'm expecting support from Andreessen. And if we are speedrun number 5, for example, there's been already 250 companies in addition to the big investments that have been made. But the team is probably not increasing by 20% after each speedrun. I think that would that be a challenge, like the expectations versus what you get as the amount of company increases? Do you see that as a challenge, or?
The good thing that it does is it provides capital for a lot of ideas in the gaming industry, right? So should also be pointing out that whether it's a good thing for Andreessen, I think the jury is still out on it. Is it a good thing for the gaming industry? I think almost certainly yes, right? Because you have a lot more shots on target for cool and interesting stuff in gaming and interactive media. So maybe we'll give him a positive shout out for that.
Yeah, I definitely give a positive shout out. I mean, Andrew Lee, Josh Liu, Robin Guo, they have been working really hard on this, and I've been to the Speedrun events. They're really well done, and yes, it's a very positive. I get constantly people reaching out, founders, asking how they can, go through to Speedrun or go through Speedrun. I don't know what it takes to go through, but I'm definitely helping them to get to that. So there's tremendous amount of demand. And yeah, I think it makes sense that what you pointed out, like emphasizing that you've been funded by the speedrun, because that might take away the edge of, let's say you're going through a follow round, let's say a seed, then you would expect that Andreessen would cover the entire seed because they're such a big fund, or at least majority of it. And if there's a signal that they're not investing into your startup after you've gone through their initial speedrun accelerator, that could be potentially a pretty bad signal for other VCs, right?
The harsh truth is, I don't think VCs owe their portfolio companies follow-on investments. I mean, obviously, you want to make sure that there is the capacity for a fund to layer in capital over time and help you grow. And maybe that also includes growing internationally and having physical presence in other, domains that you want to may enter. If you're doing a good job, your VCs will invest. Actually, if you're doing an exceptional job, they'll preempt it. And if not, does it warrant additional capital? The sober answer is probably no. Now, obviously, it's not that black and white. And obviously, I probably work and support my companies more than I should sometimes. Our clients are our LPs. Our clients are not our portfolio companies and founders. And it's not a great thing to say on a podcast, but that is the reality of venture. I don't necessarily think about it like that on a day-to-day business, but it has implications when it comes to capital and follow-on decisions, because that's where you need to remind yourself sometimes as a VC is like, getting to exceptional returns is exceptionally hard, right? Like most VC firms don't even return the fund. It's like the average is kind of like 0.9x return.
That's pretty bad.
Yeah. But it's almost, that's why it's called venture capital, by the way. Yeah. But on average, not median, it works out quite nicely. This is a case where average versus median makes all the difference for this asset class. But building good funds over and over again, like across 10, 20 vintages, is probably something in the organizational DNA and the way decisions are made and the quality of deals you see, how you pick, how you support, how you drive exits, that clearly is repeatable, even though there is all this uncertainty involved when it gets spread over enough companies by enough people that are all making high conviction bets across sectors, across geographies, pool it together in one fund. It works, and it has worked really well for us. And so actually for this current fund we're raising, we're actually not changing much. We're not changing the size of our early stage vehicle. We're upping our growth vehicle a little bit. We're not changing the team. We're not changing the sectors we're investing in. We're not changing the way we make decisions. We're collectively happy with how we run the current fund, and our LPs are happy too. Otherwise, they wouldn't be coming in again. That is a method that works well for us. So, you can look elsewhere and praise and criticize and draw inspiration, but you can also sit with the fact that whatever you have going is working well, and so you probably want to do more of that, or you just want to keep doing exactly that.
I understand the point of LPs. So your investors, the people and not the people in your case, the entities that invest into Lightspeed Ventures are its main clients, and the founders are not. Of course, that's a roughly said. It doesn't mean that you don't, because if you don't serve your founders, you won't get founders, especially
Exactly.
you won't get exceptional founders.
The one thing I do in competitive situations is I always invite prospective founders to talk to my existing portfolio founders, and I'm not going to go to my portfolio site and cherry pick who they talk to. I literally just invite them to talk to whoever I work with or where I'm on the board. I think that's very powerful. Yeah. And that's how you win competitive situations. Is you can talk up yourself all day long, right? You can bring up all your team. We have a reverse pitch presentation that shows you how great Lightspeed is, and we always want to make sure that we really hear and can demonstrate our understanding of the portfolio company we're trying to work with. But the best thing in the world is them calling up someone else who was in the same decision and deciding, or even in some cases has a couple of the other funds you're considering on the cap table too, or on the board too. Those are extremely powerful situations. That is just a very credible, zero bullshit way of trying to figure out like who's great at telling you what they'll do for you versus who actually does minor acts of magic for you on a weekly or bi-weekly basis.
Do you have to fight a lot for deals?
Fight?
No.
Physically, no.
Come on. But I mean,
okay, fine, rarely.
Yeah, rarely.
No. Physically?
No.
Rarely. Yeah.
Physically, rarely. No, but like, I of course, I don't interact with funds of your size.
The truth is, for most of the things we invest in, they don't have a pretty PowerPoint presentation and then some Google sheet where they reach out to 100 funds and they track like the first meeting, the second meeting, and all that kind of stuff. It's usually not like most of the things we invest in look more like founders already know the 5 parties they maybe want to work with. They reach out to 5, they get 3 term sheets. So my job is being one of the 5 that gets asked, and my job is to win against the other 2 term sheets.
And how do you do that? Just by showing the track record, talk to these ones, and
I think founder references are critical. I think in those competitive situations, we talk about dominating time and mind of founders. So I think it's genuinely valuable to spend time in person. To show that you can, even in those initial conversations where you're actually both trying to get to know each other, we're kind of like buying and selling at the same time. We're still doing diligence. We're getting to know. At the same time, for some situations, from the get-go, this is probably one where you, even in the first conversation, want to share a little bit about how Lightspeed works with founders, and you're immediately in some kind of reverse pitch motion. And you probably have like 10 hours of that in a successful case, all over a couple of days. Again, ultimately, founders choose who they want to work with, right? And also really listening what they care about. I don't think there's companies are unique, founders are unique. Every deal develops its own character or dynamic. Sometimes my wife asks me like, "Oh, so did you this thing, did you end up doing it, or like, or did it work out or did it not work out, and like, or where does it stand?" And sometimes I think to myself, to even just answer the question would take me like 10 minutes to rattle through everything. So sometimes I'm just like, oh, it's complicated. So these things all look different.
Yeah.
It's kind of like the beauty of the business too, right? And so when you only pull the trigger 2 or 3 times a year, when you find something you like, or you think that could be a good fit, you can really fully dedicate yourself to this. that sometimes takes 80% of 2 or 3 weeks just the deal motion.
So you do have to fight for the deals, because when that
good things are in demand.
Exactly.
Obviously. Yeah.
Exactly. That's why I was asking it, because and when you fight against
I'll just say
competitors.
yes. I'll just say yes next time.
Because when you fight with other top funds.
Yeah, but rarely physically.
No, well, rarely, but sometimes you need to. That's
whatever it takes. Yeah.
Whatever it takes.
Yeah. Those situations I typically win.
Yeah, good. At least the physical confrontation is where you excel. Yeah. So,
you want to raise your arms high and be as intimidating as possible.
Yeah, if you're a bear. But is there
I don't think the bears know it. It's against bears. It's not for bears.
But they do raise up.
They do.
When they kind of like come, don't they? At least in movies. I haven't seen bear in
I don't
live.
want to get that close to one.
Is there a tough time raising right now or not? Like, what's the current environment for VCs? So basically, not for Lightspeed, can I say for others? Because I know you might be very successful in the way you raise and you cap how much you want to. We don't know that, but presumably you will say that you're fortunate. But let's say in general, when we're talking about venture capital, is currently harder to get investments from LPs, so limited partners, given, and I'm focusing on gaming, given that we had this roller coaster of a thing of 2020, and then the whole dissolution of both the public companies, the exits, everything in gaming is not looking good, the layoffs, like all the negative news. And then when you look at the fund returns of those funds that raised during that time, which was a lot easier than it is now, and the returns are looking pretty bad. Is it now on the upswing, or like what's going on with venture capitalists raising money? Because for the listeners, it's important not that you care about venture capitalists. I mean, many people who do listen to this do, but it's important that venture capitalists have money because that money goes to founders, and when that money goes to founders, we got more companies. So we want venture capitalists to have money.
Game devs. Here at Heroic Labs, we know that great gameplay is what players love, but integrating metagame features like challenges, progression, and rewards is crucial for retention and monetization. But coding them is a tedious and time-consuming process. That's why top studios have turned to Hero from Heroic Labs. Hero provides a complete suite of battle-tested metagame features that are quick to implement, letting you spend more time on the core gameplay experience. Ready to ship fully featured, engaging games? Check out Hero today at heroiclabs.com.
There's two separate dynamics going on that aren't helping. One is, as you described, I think there have been woes in the gaming industry over the last, 18 months after like a ZERP/COVID high that created a lot of fat cats, as you like to call them.
Cat cough and fat cats.
that decide that treat over there is just too far away.
Exactly. And also Lightspeed is not immune to making big investments during the peak times, maybe before your time even. There were big investments into gaming companies that made sense during that time, but are now looking like, did we overpay for this? It's kind of perhaps even overvalued.
Especially in growth territory. This probably for large funds, like the roughest mistakes were probably growth investments during that time, which I can't take any credit for it, but that our growth team actually navigated quite nicely. So we were underexposed in 21 and 22, and then we've been very active actually in 2023 and 24. But look, that's not that predated me, and then also it's not where I focus. I do occasionally look at growth opportunities too, so my work's not limited to early stage. But so just to answer your previous question, you have that dynamic that is an industry specific dynamic, and then you have also the fact that yes, during 2020 and 21, and we benefited from it at Bitcraft to a large extent too. I think it was an extraordinary good time for new fund managers, emerging fund managers to raise funds.
Yes.
And there was significant appetite for that strategy and that asset class at a time where by and large everything was going up, and the more risk you took, the more it went up. And so that just lended itself to, venture
frothy times.
High net worth individuals, family offices over-indexing on venture capital. And I think over-indexing is probably a fair way to describe it. And I would, I think it's dangerous to look back. And this is this is particular to the gaming VC industry, maybe, because that really only has existed in a meaningful shape, if I'm not mistaken, pretty much kind of like around 2019 and going forward. Like if you looked at total assets under management in 2019 across all gaming funds, maybe there was something like $500 million across all funds, right? And now it's 10 billion, right?
20x.
Something like that. So it's probably fair to say that this is normal and that not 2020 or 21
Of course.
was normal. And that's the reality you have to work with.
Yeah. I just mentioned that in the sense that it was like the numbers are not looking good for those funds, at least at this point of time. Of course, over the next years, they will improve, but it's hard to be raising your next fund if your last fund is on the down percentiles when you look at the Crunchbase or whatever metrics you
I think some of the funds are actually doing quite a lot better than that. I think we have a few gaming funds from those vintages that are actually in top decile positions across all fund managers, across strategies. So I'm not sure if that's necessarily true. One dynamic that I don't see anyone mention that I actually think about that makes things a little bit more challenging for gaming VCs is, and again, it's beneficial to sit in a firm like Lightspeed where you just see a lot of the stuff that happens in completely different domains like enterprise or healthcare, is that I think gaming VC funds are weighed down by the dynamic that the more exposure you have to game studios, and especially the AAA kind of like PC console studios, they can't be breakouts before they launch, right? You can record markups on them, but how far can you really go on pre-launch markups? Maybe like 5x in a fantastic case. In other industries like, life sciences or cybersecurity, or really a lot of enterprise domains, you can launch a product with much less capital. You can completely blow up in year 2, year 3. You could theoretically make 100 million in ARR in year 2 or 3 of the company, theoretically. And again, it's an outlier-driven business. And so you see some of these emerging fund managers that get 1 or 2 of those right outside of gaming. And that's also what you have to compare yourself to as an emerging manager. You're basically making a decision, investing in a game studio, making a decision that this can't be more than 5x in the first 3 years. And so that weighs down vintages from 2020, 21 right now as well. They could come out on the other end quite strong, but it doesn't help. It doesn't help with fundraising right now. And I think that plays a role. No one talks about that.
I'll finish up with 3 different questions for you.
Very well.
Okay. Let's do number 1.
By the way, I think all the questions, I don't think any of these questions that you asked today were on this list that you showed me 2 minutes before I sat down.
I bamboozled you. I want to catch you as your more itself.
Raw.
Yeah, raw. I want to catch you raw. That's why I came in to your hotel. Anyways, so wake you up. Anyways, 3 questions. Number 1, do you think we'll have game-specific funds in future?
Yes. Next question.
Good.
I think, look,
all I'm saying is like this is a relatively new thing, and I'm asking this because I would hear from people sometimes. Of course, I would like to have game-specific funds. I don't have a against that, but I've heard multiple times being said. Yesterday at your party, a certain person told me in a sauna, he's like, I don't think there's a future for a game-specific fund. I'm like, interesting. I'll have this tomorrow.
Let's take it apart. So, what's wrong with the gaming industry? I think not much. It's a great, sophisticated form of entertainment. It's the most complex form of entertainment that we have. It's superior to any other form in form of entertainment in many ways, primarily in the ways that it's more immersive, it's interactive. Because it's interactive, it can be social, so it can take these social platform dynamics. I think that's tremendous. And by the way, you have massive societal tailwinds still going. Everyone growing up today is a gamer. That was not the case, and it still translates into additional growth and eyeballs. Then you have tech tailwinds, AI, other much more foundational tech advances that just make things better.
Demographic tailwinds.
Demographic tailwinds. Demographic and technological tailwinds. And so I don't see how this industry is not going to continue to have a blast over the next 10 years plus. So then the question is, so if there's value creation, then the question is, how will value be distributed? Is it going to accrue all to the incumbents, or is there room for newcomers? I don't know. My general take is there's always room for... If we've learned anything about any industry, including gaming, there's always room for newcomers, and especially when there are transformational shifts. And we are in one right now. So it's actually a pretty great time to be investing.
And I like to show the graph where you zoom out and shows the game revenues from 70s to current, and it's just like doubling all the time. Yeah. And there are years where it contracts, and then there's years that grow.
By the way, there's so few years where it contracts.
And there were some like in the 70s and the 80s, like whatever collapses.
Since 1997, there's been like 3 or 4 down years.
Yeah.
Just like last year or 2 years ago, like
after insane growth,
it goes down 5%, and everyone loses their mind.
Well, because everybody is in today and not in the zoomed out.
This year is a growth year, and next year will be a growth year.
Okay, let me ask you another one. The second one. What 1 or 2 bold predictions do you have for the next few years regarding game industry?
I have one that's non-gaming that I really like.
To shoot.
Yeah, I spend a lot of time, or I have spent a lot of time, including at Bitcraft, but also at Lightspeed, looking into XR, and it's difficult, especially for a fund of our size, because in the beginning we talked a little bit about, where's the light at the end of the tunnel for maybe a $5 billion exit in
5 to 7 years.
Yeah, so. For VR, the install base is, fair to say, too small to at least back vertical applications, including games, that can get there. Could you invest in VR hardware or middleware that would drive returns like that? Maybe, but it's hard because this is just a domain that's so overfunded by big tech, and Meta and others almost have unreasonable incentives to own that platform and are willing to spend against it in a way that's not defensible for a financial investor to their LPs. But I think rather than getting hung up and falling in love with this idea of wearing smart glasses that augment your visual field, AI actually now makes possible a class of hardware devices that could be more in the realm of logical augmentation. These could be glasses, they could be other form factors. We know there are some people working on basically, earbuds with cameras, but something that can take in the user's field of view. So, and then combine it with advances in AI to basically help us make sense of the world, because it skips the visual augmentation. You can actually press it into a form factor that's reasonable, that you want to live and can let live on your face for 18 hours a day, that can have a battery that lasts throughout the day. And some of these will come out in the next, call it 3 years or so. And I think it's going to be an awesome new compute platform. I don't think primarily for gaming, to be honest. It's just going to be a really helpful device to make sense and navigate the world.
So it's not like on your left eye there's a constant TikTok reel just being swiped.
Yeah, I mean that's the other thing. Apart from challenges in optics, field of view, and resolution, the fact that you can't really produce black on so like replacing traditional screens on those devices is far out. Even though some projects like Orion make it look like it's in reach, I think actually it's really not. But even if it were, I'm not sure people want that. And I think AI enabled hardware in combination with traditional screens, laptops and mobile phones is going to be pretty killer. And this thing is going to be able to see your screen on your phone, on your desktop, on your laptop, and help you make sense. You could literally look at something and say, hey, can you spot the mistake here, or what's going on? Or do you have suggestions for this email that I'm writing? And it would just automatically, maybe it's even connected directly to your laptop
or your brain.
Yeah, that's going to take a little bit. Again, that's probably not in the 5 to 7 year time frame. I do look at invasive and non-invasive BCIs also, but this is one where, you know, the end of the tunnel is kind of like firmly cemented and no light shines through the cracks. But we will have that. You're asking for bold predictions. Yeah. So we'll go to AI-enabled hardware soon in the next 3 years. We'll probably have smart glasses. I mean, I like to think within 10 years. And I'm actually also deeply convinced that within our lifetime, we'll switch to what's then the ultimate computing platform, which is brain-computer interfaces.
And when do the robots kill us?
What was that again?
What was Lightspeed prediction on that?
Yeah.
35.
Yeah, the official firm prediction. Yeah, actually, I take back the BCIs because on that note. This is why we invest so much in AI, you know, because if you befriend the robots, they will kill you last.
That's true. You want to be the surrogate for the next master race of cyborgs. Bold prediction for sure. If you look at it from different perspective, could be exciting or scary. Nevertheless, really good one. Last question. How has becoming a father changed you as an investor?
I'm not sure it changed me as an investor much, although it was a bit uncanny that literally as we came back from the hospital, the one call I really wanted to take during my paternity leave was the one that led to the KID investment, which is a platform for age-appropriate gaming experiences for kids and teens. And so I think my team got a kick out of the fact that I thought that's how I should use my paternity leave, was to make parenting-related gaming investments. And so it'd be ironic to sit here and tell you it didn't influence my thinking, but I have the illusion that it didn't.
At least it brought a new perspective.
Yeah, I mean, this one is a problem that needs fixing, whether you're a parent or not. And it has good traction and makes good money, so that always helps with being interested in investing in something. I think so. My personal relationship with gaming, I really think of it as, in my formative years, this beautiful foray that taught me to dissect complex systems, to break them down, to put them together in ways that other people weren't thinking about it. It's kind of like, breaking the meta really is kind of what it takes to have an edge on everyone else. Chasing global optima, not local optima. I mean, there might be a lot of retroactive rationalization here, but I really think thinking that way and obsessively thinking that way during my formative years. I mean, if there's a nurture component to it, and if it's not all just nature, then that was a big part of my nurture, self-induced, and had later on profound applications for things in academia, in professional life, in sports. And so I think play is important. I mean, ultimately, there's only work and play.
Yeah.
Play is safe experimentation where failure doesn't mean death. But play is the only time when you actually learn new skills, things, ways of being. Work is putting all the things you learned during play to work, but it's more just execution. AI algorithms work very similar, but it's explore and exploit. So I want my daughter to have that and have as much systems thinking in play. I think it's going to be the realization that screen time is a big issue, and that's going to come.
Yeah.
So right now I have this romantic perspective that the more gaming, the better. And I think luckily I'm married to a person who will reel me in, and then hopefully we'll find a good middle ground.
Yeah,
and not fuck up this kid completely.
Well, there's always another one. But I do. That's a joke.
It's a venture strategy. We'll make
one out
more.
Of 10, 1 out of 10. But I do have to say, you approach parenting to some extent like a Lightspeed partner, because yesterday you were showing us growth curves of your daughter compared to normalized, and you were showing this is 99 percentile. Look at my child. It was way above it. So this is a very Lightspeed way of raising kids.
Yeah,
it's
so
over
far,
99%.
Yeah, she has one performance metric in her life so far, which is body length.
Yeah, but you crushed it.
Yeah, she's crushing it.
Good.
Yeah,
good. More metrics.
She's putting other babies in the hospital to shame.
Yes, she's an exceptional baby.
Yeah, extraordinary.
extraordinary baby.
Yeah.
Congrats on your extraordinary baby daughter.
Thank you.
And Moritz, as always, a pleasure.
Yeah. Thanks. I mean, I can't believe that I'm getting invited back to this thing. But
well,
yeah,
thank baby Jesus. So on that note, thank you everybody for listening, and thank you, Moritz.
I think they're all gone at this point.
They're all gone. Yeah, but the employees that you forced to listen, and you're
the 4 people that are still with us,
and the portfolio companies that will be quizzed based on this podcast.
That's right.
We're still there.
Goodbye.
Thank you.
You did it. You made it to the end of the episode. As a fan of the show, it would help us out if you'd subscribe and leave us a review on the podcast service of your choice. Those stars and likes, while a small action on your part, mean a lot to us and help to grow the show. More importantly, are you a member of the Deconstructor of Fun Slack group? If you have 5 years or more of games industry experience, go to deconstructoroffun.com/Slack and apply to join. Join the games industry best professional community filled with peers always willing to lend a hand, or subscribe to our newsletter to get all the latest insights from the Deconstructor of Fun content creators. Thanks for listening.